Hi there, welcome to Kneppy Invest and welcome to my pursuit of high quality companies that are not listed on the ASX or the New York Stock Exchange, because I'm doing 5 group of companies listed on the Tokyo Stock Exchange, London Stock Exchange, and the NASDAQ. I've already looked at 2 companies that were listed on the London Stock Exchange, AstraZeneca and Halma. Now I'm turning my attention to Autotrader because this is one of 3 companies that satisfied my high quality screener that I call Rule of 10. And here it is, Rule of 10. So AstraZeneca, Halma, Intercontinental Hotels, Diploma, then Autotrader Group. These companies are all listed by market cap. So Autotrader has a market cap of about 9.6 billion US dollars. And the particular filter I'm using is companies with a market cap above $100 million, non-mining, that sort of thing, and also revenue growth, CAGR, 5-year 10% or greater, return on invested capital, 5-year average above 10%, and operating margins, 5-year average above 10%. And Autotrader satisfies these filters. So what I'm going to do is briefly discuss what this company does, and hopefully it's fairly obvious just by looking at that homepage. And then we'll have a look. At the financial history of this company, financial metrics, financial history, and then the chart. Okay, so straight away, and I sort of had an idea that maybe Autotrader was like Car Group on the ASX. This is where you sell and you buy your cars, your used cars, that sort of thing. And just by looking at this particular website, my thoughts have not changed at all. This is what I think the company does. So let's go to Fiscal AI. And Fiscal AI says that the company operates in the digital automotive marketplace in the United Kingdom and Ireland. I also think they have a website in Australia because I saw it. The company provides vehicle advertisement on websites for private sellers, as well as insurance and loan financing products to consumers. So it does seem like it's like Car Group on the ASX. And if it's anything like Car Group, yeah, I can definitely understand why it's or could be considered a high quality company on the London Stock Exchange. Founded in 1977. I didn't realize we had the internet back then. There you go. Okay, so first thing I do is when I'm looking at a company is to decide whether the company's financial metrics would qualify the company as being called high quality. And in doing that, the first step I go through to answer that question is look at growth. In my opinion, this is just my opinion. You can be different. In my opinion, a company that's not growing cannot be considered high quality. So for instance, Telstra, not high quality, nowhere near high quality for me. I don't care about the dividend. It needs to be growing for it to be high quality. Whole reason we invest, well, mostly, is to grow our capital. And the best way to grow your capital is to buy high quality growing companies. Now, the only time that is not applicable or true is when you're in the income phase of your investing journey. Anyway, so I'm going on a bit of a tangent. So first thing I look at is revenue growth. And this company barely gets there. Above 10% revenue growth over the last 5 years, 10.3%. Over the last 10 years, 8.9%. So if I was looking at a 10-year history, this company wouldn't have satisfied my filter. Sometimes I do look at 9%, even then it wouldn't have satisfied. But over the last 3 years, revenue has grown 11.6%. So there is an argument that revenue is starting to grow at a quicker rate. That's interesting in itself. Earnings per share growth, last 5 years at 7.4%, last 10 years 40.7%, and the last 3 years 7.3%. So earnings not growing as quickly as revenue. Now that could be because of acquisitions, so shares on issue have increased, or it could be because of margin contraction. So we'll have a look at that in a second. Next thing I look at is margins. Now, this is just 1 year, but we'll have a look at the 5-10-year history of margins in a second. Gross margin 79%, operating margins 62%. No surprise there, but what we don't want to see is margins dropping through time. We'll have a look at that in a second. Return on equity and return on invested capital, 5-year average, spectacular. We're talking about 47.6% for return on equity, 44.6% for return on invested capital. But again, I want to see how these quality metrics are changing through time. Don't really care about the dividend. Dividend yield 1.3%. Again, I don't think you'd be buying this company if you want income, but what you do want to see is this company continue to grow and that would mean their dividend would be growing. In fact, over the last 5 years, the dividends have grown at 34.6%. I'm assuming that's per year, which is pretty nice. Dividend pay ratio 33.5%. That's okay. Now, I would prefer that to be a little bit lower, but I'm being a semantic if I say that. Current PE ratio is at 25.5, which sounds okay. No qualms with paying that sort of valuation for this type of company that has a potential to grow a fair bit over the next 5 to 10 years. Okay, so let's just go into looking at this company's financials. So what we'll do is we'll have a look at revenue, gross profit margin, operating margin. We'll also have a look at income, and we'll also have a look at return on invested capital, return on equity, and we'll also have a look at P ratio, price to free cash flow yield, EV to EBIT, and not that one, and EV to free cash flow. And also might just have a quick look at cash flow. So have a look at operating cash flow and free cash flow. And I don't always look at this when I'm doing these videos, but typically when I am researching a company, I do have a look at cash flow. Okay, so these are all visible and looks pretty ugly. So you want to sort of make some of these invisible. And what I'll do is I'll start at the top and we'll have a look at revenue and income. There we go, revenue and income. And of course, what we want to see here is we want to see revenue increasing through time and profit also increasing through time. Now, sometimes you'll see some of these metrics dropping, and we saw that in 2020, 2021, and then it went back to growth. And in fact, if you have a look at the revenue growth for Autotrader, it's beautiful. Now, it's just doubled in the last 10 years. I would prefer that to have more than doubled from 281 million to 601 million, but at least it's going up. But maybe not the rate I'd want to see it increasing. And profit over the last 10 years has way more than doubled. Not quite tripled, but it's gone from 126 million to 282 million, which is suggesting that this company has experienced a bit of margin expansion over the last 10 years. But we can confirm that in a second or so. Okay, next thing I'll just have a quick look at is just cash flow. And I have a feeling we're going to see exactly the same thing. We'll put both in here. Yep. In fact, there's not much difference between operating and free cash flow. And we saw that little bit of a dip in 2021, but overall it has increased. Now, the one thing here is that both of these metrics, free cash flow and operating cash flow, have not doubled over the last 10 years. In fact, they've grown at a slower rate than revenue and income. And what I mean by that, we're talking about 7% per year. Revenue is growing at 8.8%, income at 9.3%. So slower growth in cash flow. Not sure what that means. It could be just a one-off. Maybe it was a little bit slower in the last year. Okay, so everything's looking good. I would prefer a little bit more growth in some of these metrics, but it's growing. What about gross profit margin? Have we seen this increase? Well, no. So I don't think we can take anything away from that. In fact, I'm going to completely ignore that and just go to operating margin. I expect this to have been increasing over the last 10 years. Well, it has. It's gone from 59.9% to 62.1%, but it's not a straight line. In fact, the operating margins has been as high as 69% in 2020, 2022, and then for some reason there was a drop. So we'd like to see operating margins increase a little bit. But it has increased over the last 10 years, but that's semantics, really. Okay, so not quite what I expected to see for margins. Okay, now on to return on invested capital and return on equity. And I expect both of these, well, I have no expectations at all. Okay, we're going to get rid of return on equity. There was 1 year where it was weird. So this is return on invested capital, and it's nice, really high. There was like one drop in 2021, but generally it's been above 40%, as high as 50% in 1 year. So this is a nice return on invested capital. I would expect a little bit more growth based off this return on invested capital. And again, their return on equity, they had a one big drop, which makes everything else just look weird. And there was a massive rise. In fact, it went up to 612% in 2019. So I think we can ignore that. Okay, so now on to valuation. Is this company cheap? 25 PE ratio. I would prefer it to be below 20. Like if it was 18, 17, I'd be saying, based off the growth, maybe looking good. But 25, I'm going to say neither expensive nor cheap. So let's have a look at all these valuation metrics. We'll start off with P ratio. Now, this is the last 12 months. Yep. So P ratio right now is at 25. And yeah, it's not at the high end. It's not the low end. In fact, 10 years ago, it was higher than this. It has been as low as 20. It did drop briefly below 20 during the COVID-19. So very rarely does a P ratio of this company get to 20 or below 20. And that may be a signal that this could be a buy. And very rarely does it get above 30. So really oscillates between 20 or ranges between 20 and 30. And it did get above 30 for a period of time in 2021. But that was a period where there was a little bit too much froth in the market. And we saw a lot of companies get way overvalued during that period. So it's no surprise that P ratio of this company got to 50. Also, was that the year where this company had a bit of a drop in some of their financials? Or was that 2022? I forget. Okay, so nothing there to suggest this company is looking good value. What about free cash flow yield? 4.28%, which is nice, neither higher than what you usually see or lower. In fact, if the free cash flow yield got to about 6%, we'll say 5.5%, that would be looking pretty good. What else do we have here? EV to EBIT. Again, just like some of those other valuation metrics, neither expensive nor cheap. Now, if it did get down to 16, it's not far off the lows we have seen over the last 10 years. So definitely not towards the highs, but it doesn't, if you get rid of that bit of a peak in 2021, it hasn't really oscillated all that much out of the range between, we'll say 16 and about 22. So it ranges between 16 and 22 over the last 10 years, usually, but not always. And finally, EV to free cash flow. And again, same as the other valuation metrics. So I'd say Autotrader is not necessarily expensive, not necessarily cheap, maybe fair valued is the way to go. Okay, last thing I'm going to do is just have a look at the chart. And we'll have a look at the long-term chart for Autotrader. And that's the daily chart. We want to look at the weekly chart. Now, it looks like this company listed back in 2015. And this is the chart of a high-quality company. Now, the share price has gone from 280 to 880. So it's not, or hasn't been a massive wealth winner for shareholders, but the share price has gone up through time. And I think the key to Autotrader is buying when it's looking cheap. It's looking good value. And if you just have a look at the 200-week moving average, that's happened. The share price has fallen below that particular moving average a few times in the past, understandably during COVID-19, and then also in 2022. But since then, it's been above the 200-week moving average. And at this point in time, it's sort of, I wouldn't say well above, but it's quite a bit above. So that sort of reinforces my thoughts that this company is neither cheap nor expensive. If the share price was, say, towards $700, currently it is, what is it now? It is 800, around about 800. So the share price dropped to, say, 700. Maybe this company is looking cheap. Maybe. Okay, so that's really all I have for Autotrader. First time I've looked at this company. If you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for the video. Have a good day. Bye.